Welcome back to the deep dive. We've got quite a bit to get through today looking at a major player in tech consulting.
That's right. We're digging into Tech Mahindra, specifically their latest financials, Q2 FY26, ended September 30, 2025. Audited numbers.
And our mission here isn't just, reading out the figures.
No, definitely not. We want to understand why. What's behind this eighth straight quarter of margin expansion they're talking about, and this big push into agentic AI.
Right.
Plus, we absolutely have to touch on that big historical financial item that keeps popping up in the auditor's notes.
Okay, let's unpack this then. Starting with the big financial headlines.
Yeah.
What did the top line look like?
Consolidated revenue for Q2 FY26 landed at $1,586 million.
Okay, and growth.
They highlighted 1.6% sequential growth in constant currency, or CC. Apparently their best quarterly CC growth in, 10 quarters, so some momentum there.
And in rupees?
In INR, yeah, it was 13,995 crores. That's up 5.1% compared to last year.
But you mentioned margins were the real story?
Absolutely. I mean, the top line is important, but the profitability piece is where they seem quite focused. EBIT, earnings before interest and taxes, came in at $192 million.
Which gives an EBIT margin of
12.1%.
12.1%. That feels pretty solid in the current market. And this is the 8th quarter they've managed to improve it.
That's what they're saying. 8th consecutive quarter. And it's quite a jump, too. That 12.1% is up 108 basis points just from the previous quarter.
Okay, QOQ. And year on year.
Even better, up 254 basis points year on year. So almost 2.5 percentage points higher than Q2 last year.
That suggests something structural is happening, not just a one-off.
Exactly, and that flows down, of course. Consolidated profit after tax, PAT, was $135 million.
Right.
Which translates to diluted earnings per share, EPS, of 13.46 for the quarter.
And with numbers like that, you'd expect some confidence shown towards shareholders, dividends.
They delivered there. A pretty substantial interim dividend declared €15 per equity share.
Wow, okay. That's 300% of the face value, isn't it?
It is, yeah. Face value is 5, so yes. A significant payout. And for anyone listening who holds the stock, the record date was October 21st, 2025, with the payment due by November 12th.
A clear signal of financial health, then.
A very loud one, yes. Backing up the margin story with cash returns.
So let's get into that margin story. How are they actually achieving this? 8 quarters in a row. What's the engine room looking like?
Well, they point to a few things. Operational efficiency, discipline, execution, sort of the usual suspects, but also cost optimization. They have this internal program called Project Fortius.
Project Fortius?
Yeah.
Okay, what does that involve? Is it just cost cutting?
It seems more strategic than just slashing budgets. It sounds like it involves optimizing the delivery pyramid, getting the right mix of offshore versus onshore, using automation more effectively, maybe shifting focus to higher value work.
So fundamentally changing how they deliver projects to make them more profitable from the get-go.
That seems to be the idea, build in the efficiency.
Did they get any external help this quarter? Currency, maybe?
They did acknowledge that, yeah. About a 40 basis point tailwind from currency fluctuations helped the EBIT margin.
Okay, so 0.4%. Useful, but
not the main story.
Yeah.
Like we said, the YoY improvement was 254 BPs, so currency was only a small part of that game. The bulk really does seem to come from these internal efficiency measures.
Here's where it gets really interesting then. If they're getting so efficient, is the demand keeping up? How's the pipeline? Deal wins.
Good question. The total contract value, TCV, for new deals signed in Q2 was $816 million.
$816 million. How do they frame that? Good, bad?
They frame it as strong growth. And, on a last 12 months basis, TCV is up 57% year on year, which sounds great.
But I sense a but.
Well, the but is that management has been pretty open about wanting to hit, ideally, $1 billion in TCV per quarter.
So they missed their own internal target by a fair bit, almost $200 million short.
Exactly. So $816 million is solid, maybe even strong given market conditions, but it's not quite hitting that ambitious goal they've set for themselves.
What does that tell us? Market softness? Or maybe the sales engine needs tuning up to match the operational improvements?
That's the million-dollar question, isn't it? Or maybe the billion-dollar TCV question. If everyone's seeing deals take longer, 816 Sema is resilient. But if they need to sell more aggressively to feed this newly efficient engine, then maybe that's the next focus area. They've fixed the how, now maybe sharpen the what's and how much they sell.
Okay. But one area that looks unequivocally strong is cash flow.
Oh, absolutely. Outstanding. Free cash flow, FCF, was $237 million.
$237 million on $135 million profit.
Right. That's 176% of PIT. It means they're converting profits to actual cash incredibly well. Collections must be tight, working capital managed smartly.
And a DSO confirms that.
Pretty much. Days sales outstanding held steady at 94 days. Consistent, solid discipline there.
Now, the people side. Efficiency often means, well, headcount changes.
It does. Total headcount is now 152,714. That's actually down by about 1,559 people compared to a year ago.
Down year on year. Is that across the board?
Mostly in the IT services segment, which aligns with that Project Fortius idea, using automation, maybe changing the pyramid structure. The BPS, or business process services side, actually added some people.
Okay. What about attrition? Always a key metric in IT.
It ticked up slightly. IT last 12 months, attrition went to 12.8%, up from 12.6% the previous quarter.
Not ideal, but maybe expected during a transformation phase.
Possibly. They are actively reshaping the workforce. One interesting point they made, though, is about visas in the U.S.
H-1Bs. Always a sensitive topic.
Right. They highlighted their very low dependence. Less than 1% of their global workforce is on H-1B visas in the U.S.
Wow, less than 1% globally. That's surprisingly low.
It is, and it gives them a lot of stability, kind of de-risks them from any, potential immigration policy shifts or visa crunches in the U.S. market, makes their U.S. cost base more predictable.
Okay, let's shift gears to the different business segments. Where's the money coming from? Communications is still the biggest chunk, right?
Still the biggest, yeah. 32.7% of revenue. But it's still a bit soft. Declined 2.2% year on year.
Any bright spots there?
They say their largest client in that space has stabilized and is actually growing faster than the company average now, but they're facing headwinds, particularly in Europe's telecom sector. They're hoping for stabilization in the second half of the year.
So comm still a drag overall. What's picking up the slack?
Manufacturing is doing well. That's about 18% of the mix, and it grew 5.2% year on year.
Driven by?
Things like aerospace, industrial work, smart manufacturing, digital twins, that sort of high-end stuff.
Okay. And BFSI, banking and finance.
Also growing nicely, 16.8% mix, up 6.2% year on year. They mentioned some new strategic alliances helping there, including a partnership with JP Morgan Payments on their system integrator program.
Oh, that sounds like a significant win. Getting embedded with a major player like JPM Payments.
Yeah, definitely a good sign. Opens doors to potentially large banking projects.
But the real standout, quarter on quarter at least, seemed to be retail and transport.
Absolutely. Highest Q-to-Q growth at 9.0%. It's a smaller segment, 8.5% of the mix, but growing fast, also up 7.2% year on year.
What's driving that? E-commerce boom still echoing.
Seems like it. Tailwinds from e-commerce supply chains, logistics automation. It fits perfectly with their focus on operational efficiency type projects.
Okay, now, the future. AI. This feels like a huge part of their narrative now. They launched something called TechM Orion, and the keyword seems to be agentic. What does that actually mean?
Right. Agentic is the crucial term. We're moving beyond just, say, generative AI that helps a human write something or find information. Agentic AI is about systems that can perceive their environment, reason, make plans, and then autonomously take actions to achieve goals.
So less AI assistant, more AI worker.
Kind of, yeah. Think autonomous workflows, not just assisted workflows. And TechM Orion is their platform designed specifically for the enabling complex business processes to run intelligently without constant human oversight.
And they've built a marketplace around it.
Exactly, the TechM Orion marketplace. Think of it like, I guess, an app store, but for these autonomous AI agents. They claim they already have over 300 of these agents being used at scale with clients.
What's fascinating here is the management doesn't seem to see AI as just this deflationary threat that will eat into their traditional business, which is a fear for many consultancies.
No, they have an interesting take. They see it as a catalyst, almost a forcing function for modernization.
How so?
Their argument is, look, you can't just plug these sophisticated AI agents into old, messy, complex legacy IT systems and expect miracles. To really get value from AI, clients first need to simplify, standardize, modernize their core tech stack.
So AI creates demand for their traditional modernization services.
That's the argument. It becomes a tailwind. We'll help you clean up your IT house so the AI agents can actually work effectively. It sidesteps the purely deflationary view.
Clever positioning. And this AI focus has national importance in India, too.
It does. They got picked as a key partner in the Indian AI mission, which is a pretty prestigious government initiative. They're involved in developing a sovereign Indian large language model, an LLM, aiming for like 1 trillion parameters.
Wow. Big scale.
Huge scale. Gives them credibility and potentially access to significant government-backed projects.
And is this AI strategy actually showing up in deals yet, even with that TCV miss?
It seems so, yeah. They highlighted specific wins where AI was central. An AI-native operations deal for a European bank using AI to drive efficiency for a global logistics company, transforming entire operational desks from human-run to AI-driven.
So the strategy is starting to translate into real contracts.
Looks like it. Immediate monetization, which is key.
Okay, we have to shift now. We've talked efficiency, we've talked the AI future,
Hmm.
but there's this shadow from the past that the auditors keep highlighting.
Yes, the necessary and critical context. The emphasis of matter in the auditor's report. It doesn't change their opinion on the financials, but it flags something specific they want users to pay close attention to.
And this relates back to Satyam, right? The company they merged with back in 2011 after the big scandal.
Precisely. It concerns claims made by 37 different companies relating to alleged advances they gave to Satyam before the merger, before the scandal really broke.
And the amount is significant.
Very.
Right.
12,304 million.
12,000 crore rupees. What's that in dollars now? Over $1.5 billion.
Somewhere in that ballpark, yeah.
Yeah.
Huge number. And it's still sitting there on the balance sheet.
Why? If it's from, what, 14 years ago or more, why hasn't this been resolved? Paid out or written off?
It's complicated. The amount is carried separately as suspense account, net. This was actually mandated by the High Court when the merger was approved. The case regarding these alleged advances is apparently still going through the city civil court.
Still pending after all this time.
Seems so. The legal wheels turn slowly, I guess.
What's Tech Mahindra's official stance on this? Do they think they'll actually have to pay it?
Their consistent stance, backed up by their legal advice, is that these claims are not likely to be payable when it finally gets adjudicated.
Why not?
They argue there's a lack of proper documentation supporting the claims. And there was also a directive from India's Directorate of Enforcement back then telling Satyam not to return these alleged amounts pending investigation. So there are layers to it.
But if they're so confident it won't be payable, why does this massive potential liability, over $1 billion, keep getting flagged every single quarter?
Yeah.
Doesn't that uncertainty kind of clash with the story of precision, control, and future focus they're building everywhere else?
And that is the core tension, isn't it? You have management projecting confidence, citing legal opinions. But the fact remains, it's a disclosed, unresolved item mandated by the courts, stemming from a major historical issue. It's this financial ghost that just lingers. It's the one piece of their financial house that hasn't been fully cleaned up or modernized, you could say.
So what does this all mean, putting it all together?
Well, you've got this picture of a company really executing on its turnaround plan.
Right, the operational discipline seems undeniable, those margin numbers, the cash flow.
Yeah, exactly. 8 straight quarters of margin improvement, driven by things like Project Fortius, strong cash conversion. That's real progress. They're clearly focused, disciplined, and they have this ambitious, forward-looking strategy around agentic AI with Tech M Orion.
They're positioning themselves for the future of autonomous operation.
They are. Management says they're at the midpoint of their 3-year plan, and they feel good about the foundations they've laid: leadership changes, organizational rigor, focusing on bigger clients, like that 20 million plus bucket.
But then there's this other hand.
Then there's the other hand, this lingering, very large question mark from the Satyam merger, mandated to be on the balance sheet, a reminder of a very different past.
So the foundation looks stronger, the future vision is clear, but this historical piece remains unresolved.
Precisely. For you listening, the investor or observer, that's the key tension to grapple with. They've demonstrated discipline, they're selling a compelling future, but this specific financial ambiguity from the past is still part of the present reality.
Which leads us to our final provocative thought for you to chew on. Tech Mahindra is building these cutting-edge autonomous AI platforms, systems designed to run complex global operations with, ideally, total clarity and efficiency. They're selling the future of streamlined, intelligent business.
Mm-hmm.
Yet the final decision on this $12,304 million suspense account, a financial ghost from a merger 14 years ago, is still pending. As Tech Mahindra positions itself to lead the charge into autonomous systems, how much does the persistence of this deep historical financial uncertainty affect confidence? Can the market fully square that circle between the messy past and the clean autonomous future they're building?